We now have a panel on the detrimental value to the race to the bottom. I'm joined by the Mortgage Mums Managing Director Sarah Tucker and two of the company's senior mortgage brokers, Shelley Walker and Sonia Marfaru, as well as Stephen Sanderford, Director of Steve Sanderford Consulting. So thank you ladies for joining me in the studio today.
Thank you for having us. We're very excited.
And thank you, Steve, for joining us on Zoom, working from home or in the office.
My pleasure, at home.
Okay, well, great. So let's get started, guys, because we have got a half-an-hour session to cover lots of ground. So I want to ask you each the same question first, which is the housing market bubble going to burst?
I mean, that is a question that we get asked a lot. Is it going to burst? I think burst sounds very dramatic and very sudden, and I think what we've been experiencing over the last year, I would say, it's not suddenly. A year is a long time. So is it going to burst? I'm going to say no. I personally don't think it is, but can it continue how it is going? That's another thing, really. But yeah, my answer is no.
What would you say, Shelley?
For me, I'm seeing where I was seeing lots of properties going above asking price and prices going up and up and up. What I'm starting to see now is things level off a little bit more now. So things going at asking price or just slightly under. So for me, I don't think it's going to be a big drop off, but I can see a sort of stabilisation at that top. And I think it will probably sit around that level for a little while and then probably steadily increase after that.
Yeah.
Ever the optimist.
Yeah, we're very optimistic at the Mortgage Mum. We always have been. So I think before, when we were told it's going to burst in March, get ready for it to go really badly, we were optimistic. And then obviously they extended the stamp duty holiday, and I think that stopped it bursting then and just kind of let it deflate slightly for us all. And I think now the rates being so low is kind of having the same effect for our first-time buyers and other people on the property market. So I don't think it's going to burst. I think it might naturally keep deflating slightly. But I think there's a lot of fear out there, and that's what we try and diffuse as much as we can, because it's still very positive.
Yeah, definitely, and positive outsets as well.
Yeah.
And Steve, what would you say?
In a violent agreement, really, with the three S's there, and I think it was Sarah who used the word deflate. That was exactly the word I was going to use. Was it sustainable to carry on in the way that it was? No. Will it slowly deflate, i.e. cool down? Yes, it will. And we've seen this over the last 10, 20, 30 years with the odd I suppose intervention of things like the credit crunch, but generally speaking, the fundamentals of the UK housing market are still the same. And as long as we don't see any sort of catastrophe, we're coming through coronavirus, we're still coming through Brexit, and both of those have had detrimental effect on a lot of things in the economy. Are they going to break the economy? Are they going to change the fundamentals of the UK housing market? No, they're not. And those are, generally speaking, undersupply of housing and a surplus of demand. So I completely agree. No, we're not going to see it burst.
Okay, good.
That's good, isn't it? That's
reassuring.
Yeah, good start.
And in terms of the title session here about the race to the bottom, is a race to the bottom really likely to make property cheaper in the long run? What do you guys think?
I think initially it's going to help. I think it's helping to the property prices increase at the minute, because if you imagine more people can afford a mortgage, so therefore more people want to buy, there's not enough property, so therefore it increases the value. Property is worth what people are happy to pay for it. So I think initially, but I think once it settles, like anything, it is going to settle. So I don't think so. I don't think it's going to, did you say make it increase?
Make it cheaper. Sorry.
Make it cheaper. I don't think so. I think if anything, it could go the other way for a little while because of the demand for property. So yeah, that would be where I sit.
I always feel like whenever there is some sort of saving, it tends to go on top of the purchase price. We saw it with stamp duty when everyone was saving the stamp duty with the relief that was going on. We saw property prices go up. They were basically adding that saving onto that purchase price. So I think that's what's going to happen, well, is happening here.
Yeah.
Yeah, and we're also seeing more and more people want to remortgage now to get these fantastic rates.
Yeah.
So sometimes not moving and improving their home because they can stretch those loans out over long periods and make it really affordable for themselves to stay in their home and better it.
Yeah.
Borrow more at a low rate.
And Steve, what would you say? Do you think this affects any of the quality standards?
Affects the quality standards. What do you mean by quality standards? Do you mean in terms of underwriting or? No, I don't think it does. I mean, I think on the previous panel we were talking about the sort of affordability strictures that lenders have to work under. They're not going to change anytime soon. So a race to the bottom in terms of rates, as I think has already been mentioned, it really only makes a difference at the margins. It probably makes things slightly more affordable for some people, but generally speaking, the fundamentals, at the risk of repeating myself from my first answer, the fundamentals are still there. Not enough housing and too many people and too much money chasing what there is. And lenders are under quite right strictures from the FCA and the PRA as to how they decide what they're going to lend to people. So no, I don't think that's going to happen.
And sticking on rates, I've got a pre-submitted question from the audience, which may have a similar sort of answer, but let's see. The London interbank offered rate disappears at the end of 2021, most likely to be replaced by the bank's base rate. So what's the potential impact for lenders, major distributors and brokers?
Oh,
a big question.
Wow. Who wants to start?
Shall I take that?
Yes, go for it.
Yeah, I think it'll have very little impact. I mean, I think it's largely a technical thing. It's not an area of expertise for me, but it's something that I have been involved in previously. And really, it is just, as you know, people will know the LIBOR rate. It's a technical rate which banks use to decide how much they're going to charge each other for certain borrowings between themselves. Sonia replaces that. Yes, there will be some differences. Will the consumer see any of that? I doubt there'll be any noticeable difference.
It's kind of behind the scenes.
Yeah.
Yeah.
And on that same theme, are negative interest rates possible in the UK?
Oh,
Anything's possible.
anything is possible. Yeah.
The last couple of years have taught us that, haven't they?
I mean, did we think we would see the rates as they are now?
Under 1%. I never would have thought that would happen.
Exactly. So I think it is an industry. It definitely likes to keep us on our toes with that. Expect the unexpected at all times.
Yeah.
I mean, anything is possible, really, I would say, with that. I like to think it probably won't go that far.
Yeah.
I don't think they will take it that far, in all honesty, but who knows?
Yeah, I have had clients contact me though asking now if banks are going to be paying them money instead of the other way around. So they're saying, could you model this for me and tell me how much my bank would owe me if we fell into this negative rate? And I was like, no, sorry about that. I think we might be dreaming about that.
But if it were to happen, do you think the mortgage market would be ready to react?
I think actually the mortgage market are very resilient. I think we've really demonstrated that. You know, it was closed in lockdown and we had to persevere with remortgages and product transfers, and we all did club together and we were all very resilient, and then it changed in an instant overnight to stamp duty holiday. I mean, what people didn't realise is we didn't know any more than anyone else. We were still hearing the same feeds on the news. At the same time, the difference is we had 20 people ringing us asking us what it meant. So we have to be really reactive. We're good at that. And so I think, we're ready. I mean, we've done all sorts, haven't we, over the last 2 years? Queuing for 95%. Value
the nightmares of that.
All sorts. So, we're ready.
I think it's a very reactive industry. You've got to be. I think, you know, as soon as news breaks, you have to be there for your clients and anybody else that wants to contact you with this information. So, I think, would we be prepared? No one's prepared for the unknown, but can we handle it? Absolutely. I do believe that the mortgage industry is very robust, resilient, and have that ability to kind of pivot and really club together, like Sarah said, and handle it. So, yeah.
Famous last words.
Yes, they'll throw it at us and be like, let's see how you deal with that.
I prefer a period of stability if we can just order that. Thank you.
It has been a lot the last year.
It has.
And in terms of reacting, Steve, maybe I'll come to you now. How disruptive has it been having more and more alternative mortgage lenders in the space? Has it been a welcome away from traditional lenders, or has it just been a lot to deal with?
I think that's an interesting question, actually. And I think, as Sonia was saying, I think the mortgage industry, whether that be lenders, intermediaries of whatever hue, it is a very resilient industry. So I think the disruption that they've brought about has certainly been noticeable over the, whatever period of time you choose to look at. But I actually think it's a good thing because new entrants, new ways of doing things, they've driven innovation, they've driven technology changes, they've driven criteria changes. And these are all things which certainly my background in recent times has been very much in the specialist lending space. So I can see how that's been a good thing that's brought what you might call the underserved customer more and more into the market. Yeah. So how disruptive has it been? Arguably not enough, because I think there still is a lot of room out there for further innovation, further disruption. But do I think it's been a good thing? Absolutely, I do, and I'd be interested in the view from the broker side of things.
Yeah,
we absolutely agree. I think the word disruptive isn't anywhere near what we would describe it as. I think, if anything, it's positive. We need it. Off the other side of COVID, nothing is a normal, straightforward situation. It requires people to really look at cases and to be bendy, really, with criteria, and that's something the specialist market is really good at. And they continue to do that. Things like holiday lets, that's become really popular, and that's quite new for high street. So, yeah, specialist lending is really popular for that, for self-employed, particularly at the minute, because we're still dealing with people whose businesses have been affected. So I actually think it's really encouraging that we've got that space. Otherwise, we'd have to say no to so many more people, and we don't like to do that.
No.
That is what causes the market problems, if you can't get mortgages for people that want them. And at the moment, that's not, touch wood, that's not a problem that's being had.
yeah.
Touch wood. And in terms of that space and going forward, do you guys think that the traditional lenders are going to learn more from these specialist lenders in terms of digitisation, the processes, and where they're going in that space?
Yeah, absolutely. We are starting to see high street lenders kind of take a more common sense approach to things, which is, for us brokers, that's what we like. We like an actual human hands on a case and eyes, and common sense and logic going into that. And we are seeing it with some high street lenders, which is lovely to see, but there is still a very clear line between the two. So there is still a market for specialist lending where it's not going to get disrupted. But I think high street lenders are definitely learning a thing or two from the specialist lenders, for sure.
And with the speed of technology at specialist lenders, do you find that builds more trust within brokers because they can get a quicker decision to pass on to their client? Because sometimes it's a bit clunky at, the high street lenders.
It's really variable, and I don't want to just lump all high street lenders into that. You're rubbish and specialist is the way, because I think they've all got a place and that everything complements each other. There's some high street lenders that have really good, efficient services where you can get an offer within 2 days. Some specialist lenders where you'll be banging your head against the wall for 2 weeks. So that's just how it is. But yeah, it's certainly, I echo what everyone's saying, and we do need that specialist market there to complement the high street lenders and give that more diverse range of offers to people.
It's like a safety net.
Yeah,
almost.
Particularly self-employed. It's very challenging when people have to rely on, last 2 years worth of accounts, and yet their current profits are way more. It just doesn't make sense to how people's lives actually are. And when you compare how people self-employed are assessed versus those that are employed, there's such a big disparity between it. We just need a bit more flexibility.
It's not possible in this current climate, especially with self-employed, to look back at those past 2 years years, because going forward, that's not going to be their typical earnings. And I think going forward again with the FCA's big focus on vulnerability, whether it'll change criteria and affordability assessments going forward, thinking that okay, well, the pandemic's been a crisis, well, for not everyone, but for most people, but whether they'll consider maybe self-employed and different people's earnings differently when it's an individual crisis, and how they base lending on that.
Yeah, exactly.
And Steve, would you add anything in terms of that trust element between alternative or specialist lenders and brokers?
I think it's interesting because the alternative or specialist lenders, almost by definition, they're new entrants into the market. And I think one of the things I've learned throughout my career is the biggest thing that you can build with brokers is trust. And so they've had to establish themselves, whether that be from a criteria point of view, service or technology. They have to do that fairly quickly with brokers, in my opinion, and they have to get it right. And of course, it will go wrong. Inevitably, it goes wrong in some way, but they have to. I think that lenders build trust by being open and honest and working with the broker community. It's not a we provide this, you do that. It's a partnership, and I think what the successful specialist lenders have done is build that partnership and learn from the partnership and what their brokers are telling them as to, well, this works, but that doesn't, or perhaps you could look at this for us. And going back slightly on the previous question, I do think it's noticeable how a lot of the high street lenders have learned from that, whereas perhaps previously they were very big and possibly, one could say, a little bit arrogant in some ways, without wanting to name all of them. But I think those in the studio will know. I think there's quite a few of the high street lenders who've really upped their game in terms of their technology and service and criteria. And I would argue that they've built that trust with the broker community. And whether you're a specialist or a high street lender, build that trust, work with your brokers, and you'll succeed. The other side of that coin is if you don't, well, guess what? You won't succeed.
Yeah, I think you need the new players within the space to drive up innovation and competition as well. So it can only be a positive thing.
Yeah, definitely.
And we've got some questions coming in from the audience now, so I'm just going to take one now for the panel, which is, does the panel think the current rate war is really necessary?
It's a good question. I think off the back of the stamp duty extension, and obviously it's just about to end again, I think people are coming off a furlough. That's something we do have to remember. Lots of people are going to lose their jobs. We're not on the other side of this thing yet. So I think it's better to be safe than sorry. And I think this is a way of, once again, injecting something into the mortgage market that's firstly a talking point, but secondly is encouraging. It's putting trust back in the market. People need that. We've got so much fear out there that people need stability somewhere. They need homes. Their homes are hugely important. They're not in the office 5 days a week yet. Their homes are really important to their sense of safety and security in general, and mental health is so important that I think that it's so much more than just mortgages and rates. It's about creating some sense of stability in a world that isn't really there yet. So I think, personally, I think it's a good thing. It's a positive for people. It's another positive talking point about property. So, yeah, I do think it's necessary.
Shelley, would you agree?
I think it's an interesting question, the phrasing of it. Is it necessary for who, So it might be necessary for the banks to be sort of reaching out and climbing over each other to get the business now because, where the rates shot up throughout COVID and it got harder at that higher loan to value, and perhaps they didn't get enough first-time buyers who they might be viewing as long-term customers. So it might well be necessary for them to be reaching out or taking on the lower loan to value customers, sort of sub 60%, get those long-term remortgage cases. That might be what they want. I don't necessarily think it was essential for the market that we had it, but obviously it is nice for anybody with a mortgage now that you can potentially get these really good rates. So I'm certainly happy about it.
Yeah, I echo what's already been said, really. Yeah, like you said, it's the phrasing of it. It's an interesting question, but also based on previous market trends as well. With the low rates, it tends to be linked to the lack of property as well, isn't that right? So that kind of goes hand in hand, and that is what we're seeing quite a lot at the moment. Is we've got, well, I know I've got clients who they've got their mortgage lined up, but what is delaying them is that they haven't got a property. They haven't found a place that they want to buy, and based on the history of the market and things, that tends to go hand in hand. Low rates, lack of property.
And we were also speaking earlier, weren't we, about low rates and the impact on the economy?
Yes, yeah.
Yeah, exactly. Yeah, I mean, people think, low interest rates are great. They're great for our clients. They're not necessarily the best sign of a great economy. It actually suggests a weaker economy, and that is the reality. So it's a bit like we're putting a bit of gloss over something, but the reality does need to be addressed still, that the economy has a lot of work to do, and our clients, for us, we just have to make sure that they don't get caught up in, well, I can afford that mortgage now. We need to make sure they understand, okay, this is probably not going to last. And so we talk about things like overpayments, and we're the boring ones sometimes. I have to say, look, it is really exciting, but in a few years, you do need to think about that the rate's likely to have gone up. Are you still going to be happy with your lifestyle if that changes? And it's probably a good idea to put that aside and to give them that idea so they can make overpayments and get used to that, still benefit from what's happening. But too often, people say, yeah, it'll be fine. And then when that time comes, you feel like you're losing money, but actually you're just getting a really good deal at the beginning. So it's all about education. Don't just look at the rate and think, oh, it's all good. But that's why we're here.
Yeah,
we're here
it's the benefit of a broker.
Exactly.
Someone that knows what's going on.
And that is what we do, tend to try to drum in, isn't it? It's not all about the rate. I think people see the rate and they're like, I want that. And it's not all, you have to dig a little bit deeper. And like you said, that is exactly what we're here for.
Yeah.
So.
And that's one great thing that's come of all of this is there was a time where people thought we'd disappear into the land of robots, You don't need a broker, you just go on the internet. And of course you can still go on the internet for your mortgages, but you need a broker to navigate this stuff. You need a safe place to ask these questions and you need someone you can trust.
Yeah.
Especially when it's handling the biggest financial commitment you'll have.
Yeah,
really.
most definitely. I don't think anyone in any form of financial services or across all sectors can be wholly replaced by robots.
No.
You still need that, the personal touch.
Yeah, I think so. And that's what we've learned, haven't we? We do still need humans.
And Steve, I just want to ask you as well about whether you think the current rate war is necessary.
No, it's not. It's absolutely not necessary. I think it's a sign of two things. One, we've talked about it before, which is the oversupply of finance, which has been a constant in the UK for 30 odd years since deregulation. But I also think it's a sign of a lack of imagination and lack of thinking in lenders. I think it might have been Sarah who started off saying she thought it was necessary, but then maybe talked herself around, and her colleagues were talking about, well, actually, it's. I think Sarah said at the end there that it's actually a sign of a weak economy, and I agree. I think great news for all involved, and why wouldn't brokers and customers lap that up? Of course they would, but it's not necessary. I think the thing for me is making sure that we're lending to the right people, and we touched on it. I think it was Sonia who said about self-employed people, and lenders, lending to good quality customers who still sometimes are excluded. And I think for me, that's where I would like to see lenders concentrating their efforts rather than and I've seen it on the inside, and I'm not innocent myself because I've done it myself, and I've worked for lenders, constantly looking at, can we take 5 basis points off this, and we'll go and market that. Well, guess what happens? You take 5 basis points off, you get yourself undercut. It's a zero-sum game. Whereas I think really what we should be doing is looking at who are we trying to lend to, and how do we do that better? And the rates are the rates, and at the moment they're incredibly affordable. So my answer is no.
Yeah, and that's not necessarily going to last, is it, as you mentioned?
Yeah.
So that's what people need to be educated about. Because I spoke to one risk professional recently who says, the banking cycle had been too good for too long, and then something like COVID happens and everyone is fighting to undercut each other, but in the end, that's riskier for the lenders themselves and also not a benefit in the long run for the consumers, because they could probably afford a slightly higher interest rate now ongoing for a longer period, rather than it to spike again in a few years' time and then be stuck defaulting, because it's the whole circle. It's no good for anyone.
And expect a similar rate when it comes to the remortgage, when most likely it's not going to be there, I don't think, really.
I think, as my answer demonstrates, like there's an argument. It depends what side of the coin you're on. If you're a consumer, as I stand by what I say about the safety and security, I think that's a lovely thing to give to people. Perhaps there are better ways of doing it, as Steve's alluded to. But the reality, it is up to us to point out, I suppose, the reality, which is what it actually means in the short term and the long term, more importantly. We can't just, we don't want to put plasters over everything just to get through the next stage, because that's where the housing bubble thing does come into it.
And do you think lenders themselves educate consumers enough on this when they go direct?
Oh, I don't know if I'd be able to answer that, purely because I haven't had that experience. So I'm not sure how they operate. I guess taking a guess at it, they would have to be that level of compliance and care and due diligence to the consumer. So I'd like to. I'd hope they would.
If a customer went direct to a lender, you mean?
My instinct would be that they probably wouldn't.
They wouldn't,
Because I don't think that they spend their time and invest it in the customer. It's more about selling a product of the bank. So I know obviously they do have to fulfil statutory obligations, but I find a brokerage service much more personal.
Yeah,
absolutely. I think with the lenders, I think they would do perhaps like a tick box, more of a tick box exercise, rather than making sure that the customer really
read it off the ESIS.
this is what it's going
may
to
well
be,
go up, and this is what it could look
Yeah.
like. But will they go under the skin of that and say, what does this mean for you? Let's look at your budgeting plan. Let's say you might not be able to have this anymore. Let's talk about your wages. Are they going to go up over the next couple of years? Will you be able to deal with that? How could we stretch your term? Like what would be your solutions if that does happen? So you know it from the outset, and that's what we're trying to do every day for people.
And that's a problem in itself if people aren't offered that advice. Would you agree, Steve?
Yeah, I mean, I think it's a really interesting question. I mean, I couldn't speak for what lenders do in-house with their advisors, but I think there's a reason why the broker market has gone from, I think Sarah said earlier on, people were talking about the demise of the broker market not so long ago. Well, it's now sort of firmly re-established itself, as more than the lion's share of the mortgage market. And I think there's a reason for that. It's because brokers provide the service, the reassurance, but also that sort of steady hand on the shoulder as to don't overstretch yourself and remember that, it might look rosy at the moment with a 2% interest rate, but don't forget that in a few years' time, your circumstances, your family might change, your employment might change, and interest rates might change. So I think there's a good reason why the broker market is so healthy, and I think it will continue that way.
Okay, well, let's hope so.
Let's hope so. That would be good to know.
So that's about all we've got time for. So thank you so much, ladies, for joining me in the studio, and Steve for joining us from home.
Thank you.
Thank you so much for having us.
Well, I think that was a great panel, and it's now time for lunch. So go and grab a bite to eat, continue networking, and we'll see you here at 1:30.